Okay, so let's take a look at the second part of this first PowerPoint on the chart of accounts. Now, we left off by looking at accounts receivable. We had looked at an example of a chart of accounts. Accounts receivable is a typical account that would be on there. It's an asset. The type of account it is, it's an asset. Assets are things that the business owns that will provide future benefit. And we looked at a number of examples of assets and including accounts receivable. And we said that accounts receivable is when the customers owe us, the business. And we get this by making sales on account or on credit. This doesn't mean on a credit card. So the customer comes in and buys something and they take the thing with them out the door, but they have not given us cash, or they only give us part of the cash and then they're going to pay us the rest later. You may be more used to, say, a furniture store doing this as opposed to, say, Walmart. If you want to buy something on credit with Walmart, you use a credit card. Well, that's not on credit with Walmart. That's you have credit with the Visa company or MasterCard company or whatever. And so you owe the money to them. They're going to give the money to Walmart. So Walmart considers that like a cash sale as far as they're concerned. Okay, but if a store sells to the customer something where they have to wait themselves to get the money, that's where we say they're making the sale on account or on credit. Okay, in that case, the customer owes the business some money, and the business will receive the money in the future. So it's called accounts receivable. Okay, the business still owns that money. It happens to be in the customer's pocket. Okay, so let's go on to the second type of accounts. It's always listed second in a chart of accounts, and that is the liabilities. And this is the probable future outflow of assets as a result of a past transaction or event, meaning that in the future we're going to have to give up an asset, typically cash. So, in other words, if the business purchases some kind of something, equipment or inventory on account with a vendor, that means we're getting that stuff right now, but we're going to pay in the future. Right now, we owe out to that vendor or that supplier. So we have a future outflow of cash. We're going to have to pay the vendor at some point. Legally, we owe that vendor. They can take us to court, etc. They can repo the item. Okay? So, in other words, we owe out the business. Whenever we say we, the business, owes out to others outside of the business. We call them creditors, suppliers, vendors, creditors that we owe out to. That is liabilities. Whenever we owe out to someone, the account is going to be in the liabilities section of the chart of accounts. Here are some examples of liabilities. We have accounts payable, notes payable, wages payable, taxes payable. Notice that all of these have the word payable, meaning we have to pay in the future. Right now, today, we owe it out to someone else, but we're going to have to pay it in the future. Payable. So accounts payable stands for when we owe it out to a vendor or supplier. Notes payable typically means we're going to owe it out to a bank, although we can also owe it out to a vendor. Wages payable means we owe that money out for wages to employees. Taxes payable means we owe it out to some governmental agency, the state or the IRS maybe, for those taxes, depending on what kind of taxes they are. Accounts payable is an unwritten promise to pay the supplier for the assets that we purchased or the services we received from them. So if we purchase some inventory, which is an asset, but we're going to pay them later, that is an unwritten promise to pay. They're just going to send us an invoice and they're going to say we got to pay it in 30 days. We're not signing a bunch of paperwork. If you've ever purchased a car and you have a bank loan, you have 5 zillion pieces of paper that you have to sign. Okay? This is just an invoice or something. Now they're going to check our credit usually before they agree to set up an account for us. Okay? But it's basically an unwritten promise to pay. It'll still hold up in court though. So here we're making a purchase on account or on credit of either assets or services. So if we purchase, say, the use of electricity from the electricity company. Typically, if you get electricity, you're going to get a bill and you have to pay that bill. But normally, most of us don't pay the bill the day we get it. We're going to pay it in the future, next month. And so we have made a purchase of electricity service on account. So if the business does that, then that is also part of accounts payable. Now down here in the red, it tells you to be careful. Don't confuse the accounts receivable and accounts payable. You have to ask yourself, are we waiting to receive? In which case, we're going to receive in the future. It's going to be accounts receivable because the customer owes us today, but we're going to receive it in the future. That's accounts receivable. That's an asset. We own that money. It's just in their pocket right now. Accounts payable means we owe it out to creditors outside of the company. We owe it out. We're going to have to pay it in the future. So accounts payable is a liability because today we owe it out. In the future, we will have to pay it. Notes payable means there's an actual written promise to pay, where it's going to say right in there, we promise to pay this amount to this person on such a day, along with some interest. Okay? If there's a written promissory note from a bank for a loan, we get a loan out and we sign a promissory note. Or we can get some stuff from a supplier or vendor, usually something bigger like a piece of equipment or something that they may have us actually sign a written promissory note. Then instead of being called accounts payable, it will be called notes payable. It's still the same thing. We owe out right now today. We're going to have to pay it in the future. And so it is a liability account. It's just notes payable because there's a written promise instead of accounts payable, which is an unwritten promise. Okay, so we've now talked about assets and liabilities. And now we have owner's equity. This is our third major type of account. It's the third type of account that's in our accounting equation that we'll get to. This is the amount by which the business assets exceed the business liabilities. It's also called net worth. We use an account called the capital account to keep the owner's equity in. Here's an example. If the business has total assets of $100,000, total liabilities of $60,000, what is the owner's equity? Once the debts are paid, that's the liabilities, are the debts, okay? The remaining assets that's left over, that don't have to go to pay the debts, belong to the owners, which is called the owner's equity. So in this case, if we take our assets of $100,000, we subtract out the part that we owe out to the creditors first, the $60,000, then whatever's left over of the assets, the $40,000, is what is owner's equity. The owner has equity in that leftover equipment, etc. We can also switch this around. Here we have assets minus liabilities equals owner's equity. We can switch that around, and this is all known as the accounting equation. So the most common way of putting it for the accounting equation is assets equals liabilities plus owner's equity. Okay, that's equal to assets minus owner's equity equals assets minus liabilities equals owner's equity. I can add liabilities to each side of the equal sign, just like any math equation, and get this that's in the red box. And that's typically how we say it. It's correct any way we put it, but typically we're going to say A equals L plus E, meaning assets equals liabilities plus equity. Okay, now we talked previously about there being 5 types of accounts in the chart of accounts. And the first 3, assets, liabilities, and owner's equity accounts, are the 3 major types. Now, revenues and expenses are subtypes, which are attached to owner's equity. Okay, they're subtypes of owner equity accounts. Okay, and revenues are accounts that we use when we sell something, when there's sales of products or services that the business makes sales. Then we're going to use a revenue account from the chart of accounts to record that sale. Expenses are accounts that we use if we're using products or services. So we're using electricity, then we're going to use electricity expense or utilities expense. We're using the phone, we're going to use telephone expense. We're using office space, we're going to use rent expense. Okay, so whenever the business is using some kind of products or services, then they will record that in an expense account. We have a second part of the slideshow that delves more into revenues and expenses. So here's our accounting equation again. And again, this is the favored way of putting it. It's not the only way it can be put. But the accountants like to put the assets on the left side of the equal sign, liabilities on the right side of the equal sign, and owner's equity on the right side of the equal sign. This way, on the left side is the assets. Everything that the business owns is on the left side of the equal sign. Whereas the right side shows where the money came from for the assets, and also